Okay, so in this video, I want to go through how every trader should be framing their trades. And that comes in a three-step process, which is basically your bias, your narrative, and your model. Okay, so understanding what these things are and implementing them in a step-by-step process will allow you to catch better trades and be more on the right side of the market. So personally, I use ICT's concepts, but whatever concepts you use, whatever type of methodology or strategies you use, unless you're using something algorithmic and completely mechanical that a bot does, then it doesn't matter. But if you're using anything where there's some discretionary requirements, then this is the best way to approach it, right? So, what is your bias? So, a bias is basically where you see price being drawn to, where you see price going. So, it's generally your target, where you're expecting price to go, right? So, for me, as per ICT's concepts, that is the draw on liquidity. That's what I use as my target most of the time. Sometimes it may be a very significant inefficiency in the market, but your bias is basically direction, right? So I'm going to write it here. Your bias is direction, where you see price going, in the main direction, right? Because price can be going up, down, left, right, depending on the time frame. So it's it's the main direction you see price going. So once you determine a bias, then you can come up with a narrative. So as the word implies, narrative is like a story. So how is price going to go to your bias? Is it going to go directly there from where price is now? Is it going to, if you have a bias of higher prices above a swing high, is price going to retrace first into an area of inefficiency, or back to a trend line, or RSI oversold, whatever it is? That's the narrative, and that's what you're waiting for. So your narrative is your story, and it's basically, I think, your POI, so your point of interest, which is the area where you're interested in taking a trade. Now, after showing all this, explaining all this, I'll go through how I implemented this in a recent trade that I took. So, after you determine your narrative and your point of interest, where you where you'll be waiting for price, basically. So you set your alerts maybe, and when price comes to you, you should always wait for price to come to you, and that's where you'll start looking for a trade using your model. Okay, so your model it's basically your entry, right? It's basically it's your confirmation and entry. Okay, so you have your bias, you know where price wants to go, or you have a good idea. This is using your experience and skills, right? That you've attained um, from learning and just general trading and viewing the charts. Then you have your narrative, which also comes from your experience and the techniques that you're using. Then you have your model. So when price comes to you, a point of interest, you are using your model to enter the trade. Usually this three-step process comes from a top-down type of analysis most of the time. Your bias may not always have to be on a higher time frame. It could be, for example, for me, relative equal highs or lows, which I'll show you in a minute. And your narrative, usually on a multi-time frame basis as well, and your model, a lot of the times on a lower time frame. So that allows you to catch a a decent RR type of trade, right? Because you're getting in on a lower time frame. You can set your stop loss. You're waiting for that confirmation. It doesn't have to be on a low time frame. It doesn't have to be on the minutes time frame. Okay, this is all relative. Your bias could be on the monthly, your narrative on the weekly, and you're on the daily. You're waiting for that confirmation. But again, it could be on the hourly, the 5 minute, 15 minute, and the 1 minute. It doesn't matter. It doesn't matter what time frame. Look at the minutes time frames that I have. I have 1 to 7, 8, 1 to 10, 12, 15. I have all the hourly time frames up to 12, and then a 20 hour. I have a daily until the 5 day. I have a weekly until the 3 weeks, because the 4 week is a month. And I have the monthly time frames all the way to the 12 month. So, it doesn't really matter. There's no secret time frame combination that I know of from my experience. It's all relative, but I will say that all the time frames kind of are working in unison, and they all matter. So yeah, I'll give you an example of a trade I took, which was yesterday. So what was my bias? Let's move this to the side first. So recently, Euro has came into a 4-month inefficiency on the 4-month time frame up here, right? And so I'm expecting a retracement. We go down to the weekly. So let me move this to the side. The weekly, we had a rejection and we're not closing above. I am anticipating price coming lower, okay? But on the time frame I traded, I took a long. So it's all fractal. So we'll go to the daily time frame. We came to some daily inefficiencies. In most cases, I would think we're moving lower, but there hasn't been any high impact news as of late. So I'm anticipating a little bit more consolidation and for price to come back into a premium. Quite possibly, that's a possibility, although there is equal lows here, which are often my target. But on a lower time frame, I targeted some equal highs. Okay, so let me go down to just straight away to a lower time frame. Okay, so this was the trade I took. All right, so over here above Asia, price created some relative equal highs here, and it just took this one out a little bit. At true day open, price took out Asia's high, and I saw these equal lows here and this inefficiency as well. Okay, so what did I do? So now I have my bias, which are these highs and more of the inefficiency, and I also left this open as a possible target, this order block here, and for price to possibly be coming above these equal highs and the inefficiencies here. I don't think we'll be breaking up just yet, but this was my intraday trade. Targeting these equal highs, I was waiting. At this point when price was here, I was waiting. So I had my narrative down here, my POI. Okay, put this in yellow. This is where I want to take a trade. Bias up here, above these equal highs. That's my bias. My narrative is down here. Yep, and down here. And my entry was in here. My model, basically, one of my models that I took, which is basically my entry. I have a few models that I take. So yeah, let's go down to the lower time frame. So you can see price came all the way down. It created these equal lows here. This is an equal highs here as well, yeah? So this is further increasing my confidence in the narrative. As you can see, price came down over here, and now I'm waiting. I'm down on the 1 minute now at this point, and I was waiting, and I waited for this change in the state of delivery. I call it a candle order block. At this point, just before it closed, I got in, and you can see in this candle, it's somewhere, it's about here. Okay, I got in and stop loss below this low, and there we go. It happened at a very common time, which is around 4 a.m. New York time, 3 to 4. These things are likely to happen, and that's part of my narrative. Okay, this tendencies in certain times of the day, days of the week, etc. So this is my model. I could have got in at a later area, but I managed with a different model. But I got in here, and it yielded a pretty good R trade. So yeah, price expanded, took out equal highs, came down again. Oops. Sorry, got lost. Yeah. Consolidated, took out equal highs, came back down. And yeah, expanded, consolidated, and then one final push. So the whole trade itself took about 3 hours, and it was a trade during the London session. So yeah, pretty simple, right? You got your bias, you got your narrative, you got your model. So if your bias, it's your direction. Your narrative is where you're waiting for price to come to you. And your model is that confirmation where you get in the trade. Okay, so everyone has different strategies. Whatever you're using, see if you can implement this. And if you're trading ICT concepts, then I think this is a must, because you have the ability to have a high win rate or high RRs. I mean, it's there. It's open to you. So if you do it this way, you definitely can catch those things. It's not, of course, not crucial. Having a win rate of 50% and an RR average R of like 1.5 or 2, that's more than enough to make you wildly successful as a trader if you compound your gains and do it like that. So yeah, so I hope you found this video quite useful. And yeah, if you have any questions, feel free to leave a comment. Okay, till next time, happy trading, and be safe.